can retire, but when should we make that move? Are there some right times and some wrong times to say goodbye to the daily grind of our jobs? Tom Curran with Curran Investment Management is here with the answer. Thanks so much for joining us.
Thank you for having us.
Well, first of all, normally people would work 30 years or 25 years or however many years, accumulate cash, and then start thinking about retiring after those 30 years. Are you saying that people are looking at this differently now?
No, I think they're looking at it more or less the same, but the difference is that what we found from history is that the best times to retire are really, in the minds of most people, the worst times to retire.
Huh, okay, so you have a graph. How did you do this?
Well, what we did is we said, what would happen if we took a look at 10-year returns? That is, if you retired 10 years ago, what would you have expected to have received in the markets? It's not a good picture. What we found is that there have been 4 times since 1880 when the markets actually experienced 10-year rates of return that were less than 0, this being one of them. Obviously, if you retire during one of these periods, the returns are not very good.
Right.
But if you retired, for example, in the mid-30s, the stock market actually quadrupled from 1932 until 1938.
So how does that relate to today?
What that relates to is that each time this has occurred since 1880, after we've had a period of negative returns, the next 10 to 20 years were extraordinarily good.
So we are not having a great time right now, although the market is up. So you're saying to people that save as much as you can over the next 10 years because that may be the time when you want to retire at the end of that?
If you're in your 40s today and you're reacting to what we now feel, and what we now feel is don't take risks, own bonds, that is exactly the wrong thing to do. If we did that in the 1930s, for example, we lost out on one of the most extraordinary periods, a quadruple in the markets from 1932 to 1936, because people were feeling and not thinking. So this will prove, I believe, to be an extraordinarily good time to be invested in spite of all the bad news. Sometimes we get to do, in terms of the economy, in terms of the government, we tend to do what's best in periods of distress, and we tend to do what is not necessarily best when things are too good. So people were extraordinarily optimistic in the 1990s. They saw no end to it. In the 2004, 2005, we believed that real estate would go up forever, and that makes us too confident.
I want to ask you a question because we're running out of time. How are people responding to this? Do you think because you have this and you're showing this data over the years that people are going to take your advice and they're going to invest?
No. No, they're not. They're going to buy bonds. They're going to get conservative. They're going to reduce the number of stocks they hold. And they will, in our opinion, again, using history, miss out on probably a wonderful 10 to 20 years of history as any guide to the future. Okay,
Tom Curran, we thank you. We appreciate you coming on. You're always positive, and you have these great scientific, stats. But again, it takes people to be able to want to take some sort of a risk.
That's right.
Okay, thanks a lot. If you have any questions about today's broadcast or any questions for Tom, we'd love to hear from you. Email us at midday@wnyt.com. The day's top stories are just ahead.